This week, interest rates held near their best levels in a month as Fed Chair Powell testified on Capitol Hill. Let's discuss the big news of last week and gear up for important events in the week ahead. Powell on the Hill. Given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace. That was Fed Chair Powell on Capitol Hill this last week, reminding markets that the Fed rate hikes are nearing an end. This next Fed meeting is at the end of July. If the incoming data continues to show inflation coming down and unemployment going higher, the Fed may very well not hike rates again next month. Currently, the markets are pricing in a 75% probability of a quarter-point rate hike next month. This will likely change as news comes in. Homebuilders are feeling good. As a sign of long-term confidence in the housing market, homebuilders put shovels in the ground at a rapid pace in May. Construction of single-family homes jumped 21.7% from April as they tried to meet soaring demand. Housing starts rose to a 1.63 million annual pace in May, up sharply from 1.34 million units in April. There are many reasons for builders to be optimistic about the future, such as housing demand remaining high in a very low supply, tight labor market, and don't forget, jobs buy homes, and the Fed nearing their hiking cycle. Bank of England with a rate hike surprise. In response to higher than expected inflation in the UK, the Bank of England raised rates by 0.5%, more than the expected quarter point. The bank also said more rate hikes are coming to help lower inflation. This is important to follow. Their inflation is over 8%, and next month our consumer price index should come in at around 3%. They are well behind the US in monetary policy and inflation and must catch up with even more rate hikes. This could add to the uncertainty and volatility in the months ahead. Interesting to note that the UK long-term rates improved on the hike as markets feel the Bank of England regained credibility in its fight versus inflation. This is another example where rate hikes help long-term rates. Bottom line, the higher for longer narrative from the Fed and clear technical factors are limiting the improvement in rates. At the same time, we can look at home builder optimism as a sign the worst may be behind us as it relates to rates and inflation. There are many great opportunities to be had and more coming. Now, looking ahead, this week we will get a reading on the Fed's favorite gauge of inflation, the Core Personal Consumption Expenditure Index, or PCE. It is expected to fall to 4.5% in May, down a couple ticks from April. It's important to note that when the Fed say they want inflation to run at a 2% level, they are talking about this index. The Fed is forecasting core PCE to come down to near 2% in 2025, so short-term rates will remain higher for the time being. All right, let's go ahead and take a quick look at the mortgage bond charts and see what's happening on the interest rate front. So as we take a look at the last 6 months of mortgage-backed securities, as a reminder, as bond prices go up, rates go down, and vice versa. The green days are good, red days are bad. You can see here that we've been fairly range-bound since the beginning of June, with lid on rates really going much higher, but not much lower either. Conforming 30-year fixed rates are in the 6.5% to 6.75% range, with FHA, VA about 1% lower at 5.75% to 6%. So not too shabby there. I do appreciate you spending a few minutes with me here today. Feel free to like and comment below, and enjoy the rest of your week.